Hang Seng is lower by 200 points.
Deposit growth of 22% YOY is perhaps the best that you are seeing in last 4 years.
It was a good set of numbers, no two ways about that. Strong operational performance overall.
600 roughly. That's the hourly exponential moving average for the Nifty.
ICICI Bank's quarterly ROA and HDFC Bank's quarterly ROA, the gap is now 35 basis points.
Performance of Geo, it was fairly in line.
So very quiet, but with a bit of a green bias to it.
For asset quality is quite good. What we guided is 1.6 to 1.8%.
We have 1,000 crore of personal book and maybe 1,000 crore of our credit card book.
SIP boom is on at 15,000 crores per month. So that was that cushioned the sell-off by foreigners.
The passenger rail system business should also start contributing more significantly.
Just up 0.1% on the Nifty and the Sensex, but at least there is that intraday recovery.
Gross contribution is definitely improving as the raw material prices have gone down.
Regulator mandates a minimum solvency of 1.5 times to be maintained by any insurer.
For the Nifty, absolutely flat right now with some negative bias.
Well, that was the day so far. You're with us here on a fresh new edition of Closing Bell. The big story, of course, is ITC, which has broken in the last 6 or 7 minutes of trade. And that's going to be the focus, number one focus here over the next 60 minutes. We're coming to you from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. Surabhi and Nigel join me here over the next hour or so. Guys, hi.
Hi, Prashant. Hi, Nigel. I guess ITC is the story. I think the market's already wondering how the structure is going to play out because 40% is being held by ITC, and I think the remainder of it, the 60%, goes to shareholders in this new entity that's going to be formed. So I think we'll have to work out the different sort of swap ratio scenarios, because it seems that that there's some quibble over there, which is why this much anticipated event and the stock had also run up. It's not exactly what the market was hoping for.
No, but actually, the stock has run up in anticipation of this. And Mangalam, he broke this first year on CNBC TV 18 and he gave the market a heads up. So from that price, it's still much higher. Why is it positive? Well, in terms of revenue, it contributes 3-4%. In terms of EBITDA, 3-4%. The problem was that in terms of capex, it used to take out close to 20% of the total capex of the entity. So if that goes apart, then it makes the return ratios look much better for the listed entity. That's X of the hotels business. And also the ROC was only around 10% for the hotels business. So it gets rid of that capex guzzler, as well as it will make the ROC of the remainder part of the business look much better. Mangalam will join us to give us further details, but these are broad details that I had down 3 to 4% of revenues and EBITDA. But the good part is the capex moves out and the ROC will improve for the remainder of the business.
But this 40-60, I think we'll have to get some more analysis going around this, because it's not like shareholders get to hold the hotel business clean. It's not a clean out completely. 40% will be retained by the listed entity ITC, and then there's a 60% which gets sort of farmed out to current shareholders in proportion to the shareholding they already have in ITC. Maybe that's a disappointment. It doesn't seem to be a very simple structure. Maybe it has, it's a two-layer structure through which you'll get to hold the hotels business. Perhaps that's one reason why.
Possibly. And, we'll have Mangalam and analysts join us. But sometimes it is also just simply the fact that, you buy the rumor, sell the news. Right? And I think some of that perhaps is at play. And we were talking about this with guests and kind of wondering if, because this was it was expected, as Nigel said, Mangalam had broken the story on the 5th of July, and there was expectation that it's nearby. So the announcement is in, and that's the first reaction, immediate reaction, which is starting to come through. Well, otherwise, it's been a pretty sort of choppy kind of session all day today, and it's been up and down, and you'd be right both ways, having different market views. The Nifty, it's a sharp V kind of graph, right? That's 12 noon. Exactly at 12 noon, the market made the day's low at 19,670, and after that, it's seen a strong recovery. That last dip that you see is all thanks to ITC and that 3.5%, 4% cut that you saw coming through post the announcement. Most financial earnings reactions are flat to low or flat to negative. And except credit access, which is up 5%. Otherwise, just take a look at what most stocks are doing, and they're unchanged or slightly down. Small cap index is still going strong. It's another 0.75% gain there. So no stopping, and advanced decline is about 1:1. So it's a mixed kind of picture overall. But I have to say, even with stocks which are going in the broader market, the advantage I would still say is with the bulls, even though market breadth has now actually turned a little bit in the negative, because volumes are tremendous volumes and stocks which are going up, and volume-led losers are still, I mean, a limited set at this point in time. Nigel.
Well, you know, the high and low of the day should come up for you on the screen. We've been in that vicinity of around 100, 110 points difference. You know, the broad range should come up for you, and that's the range that we've traded at for bulk of the day. In terms of the options data, well, 19,700 put, that's the most active put. And on the upside, the 19,800 call is most active. So you just plug in the numbers, you know, going by the premium out there, and take a look at it. Massive open interest in a single day. You have more than 1 crore shares traded out there. Now, the premium both these two strikes is anything between 60 to around 80 rupees. So you plug in the numbers, the options data suggesting that 19,630 on the downside. Well, that's the level you should be looking at, 19,630, 19,650. While on the upside, a move towards 19,900 odd will be met with some bit of resistance. For the time being, we're bang in the middle of that range and holding steady. HDFC, AMC though, those numbers come up for you on the screen. The revenues I read was up closer around 10%. The net profit as well is up closer around 52%, but we're waiting for clarity on the TER. You know, that could come any day now, and Yash has been on top of that. Survey.
Well, just a few more pointers from the broader markets, because the mid-cap index has actually held up the entire day today. 0.25% gain, not too much, but nonetheless, there's been green very consistently on the screen with respect to the mid-cap index, particularly in the second half. A lot of your plays relating to the PSU space, they've been doing well. So PFC, REC, of course, on PFC, you'll hear a lot more. There's this whole story about this mega lending package. So they've gone ahead and done tie-ups with a whole host of companies on the renewable side. And we'll tell you more about that in just a bit. But NHPC, SJVN, these are stocks on the higher side. Canfin Homes continues to react to its numbers, 5-6% up over there. Aarti Drugs in the mid-cap arena has been a very strong result reaction that we have seen today. So it's not all bad, actually a fair amount of positivity if you're looking at stocks on the upside. In terms of outsized reactions on the downside to earnings, two stocks would stand out today this afternoon as we kick off the show. Tejas Networks is one. There's also some issue with one of their vendors, and there's part of that business, the EMS business, has not come through. So that one-off has also led to a 6% decline on the stock. And the other is IGL. IGL has been disappointing in terms of earnings, and that stock's also down 5%. So lots of movers and shakers as we kickstart the show. Let's straight away get to the trading strategies. And for the last hour, we have Mitesh joining in. Mitesh, good afternoon. Very, very range bound on the indices. Do you have a trade on the Nifty or the Bank Nifty now?
Good afternoon. Nothing much on the indices. I think they are actually showing signs of contraction. The good thing is that Nifty hasn't broken 19,700. Rather, we have not seen today's low, because we did go intraday below that 19,700, but didn't get an hourly close. So 19,670 is the new pivot. I think as long as we are above that broadly, there is a chance of consolidation happening. But if we start breaking down 19,670, then maybe a short side trade can be opened up. On the stock side, I have a buy on TVS Motor. Disclaimer: we have recommended this to a client, so there's some vested interest. But this is a buy with a stop below 1348 for targets of 1420, and also a buy on GMR Infra, which I think is having a very strong session today. Good price volume action, so that's a buy with a stop below levels of 45.40 for a target of around 49.5.
Okay, Mitesh, by the way, it's a news-related immediate kind of move, knee-jerk move, but ITC, any thoughts, Mitesh?
I think, Prashant, while I think very clearly there's a news flow attached to it, you should just look at the stock pattern. I think in the last 1 hour when the stock price has fallen from 490 to about 470 odd levels, the volumes have been highest in that 1 hour. So I think there's some selling happening, and I think the stock was also very overbought. My sense is that the stock is heading towards levels of 460, 455. That range should act as a good support area. That is where the last high was made, as well as the moving averages are placed there. Some retracement levels also are there. So if it holds those levels, then I think all is okay. We just will take this as a normal pullback to the averages, and then after a few days of consolidation, the stock can move again.
Okay, we'll try and get Mangalam in just a bit. By the way, more numbers pouring in. SRF, it was supposed to be a really dull quarter for SRF, top down. Let's see what they've done. Numbers are on our screens. 359 is what the reported number is. So yeah, they've missed even the poll. And the poll itself was very subdued, pointing towards a decline on the top line, on margins, on EBITDA, on most parameters. So subdued expectations, and SRF misses even those, and the stock is reacting negatively now.
Okay, well, while we will have Mangalam join us on ITC, I think Abhishek is with us to run us through what's happening on PFC. The stock is another one of those big movers today. It's up some 6.5%. Abhishek, take it away.
Gross NPA ratio and net NPA ratio are perhaps one of the lowest that you are seeing in last 8 to 9 years at about 2.76% and about 0.48% respectively. Unsecured book is the highest in last...
Okay, I think I think we'll have Abhishek back with us in just a bit on PFC, but that coming up. Deepak Shenoy is with us, so let me go across to him. He's founder of Capital Mind. Deepak, good to have you with us here. Thank you very much for your time. Let's just start with ITC, I mean, because that's the big one. What do you make of the news, and what does it mean for those who are holding the share from here?
So we are also holders of the share in one of our portfolios. So I think, Prashant, what's happened here is the demerger is like, well, it's a sort of demerger in the sense 40% will be still held by ITC, 60% with everybody else. I think that's because it avoids hostile takeovers of the business by someone else. But it also allows ITC to provide clarity to management. We haven't seen any, I mean, I don't know any currently, I don't have an idea of how cash allocations will be going forward. Will there be cash allocations to ITC hotels from the core business of ITC, which is generally a very high free cash flow generating business, or is it something else? We'll have to see how this pans out, but it's a good thing, at least from a starting point, to separate out the individual businesses. Eventually, I suppose FMCG itself is FMCG plus tobacco, and both of them are, very independently well-run businesses. But separating out the hotel business will actually give shareholders the ability to participate only in the hotels play, and perhaps for the hotels play to launch more acquisitions or inorganic strategy as well.
Okay. Got that. Deepak, stay on. More questions in just a bit. But let's bring in Mangalam as well. Of course, he alerted us. He had broken the story a couple of weeks back. I think it was earlier this month, Mangalam. So it's gone through, but I think everyone's trying to understand this 40-60 structure that the company has come out with. Tell us more.
Well, the detailed rationale, that the company will report as to why this structure would be on August 14th itself, I guess, when the board meets, and then there is some clarity on what they propose to do going forward. The street is a little confounded on this 40-60 structure, like you said, but a large part of that, my sense, is primarily to retain the management of the hotel business itself, because ITC per se, as a company, has no large shareholder classified as the promoter of the company, and the large shareholders that there are, hotels is not one of their core businesses. So maybe to retain the management control of the business, we could have had the board, or the advisors talk about this structure itself. But talking about the structure, the company will hold 40% stake in the new entity. The balance 60% will be distributed to shareholders on a pro rata basis. So that would have a market-determined valuation of the ITC hotel business. And together, they will continue to own the synergies of the business itself. So that will be a big positive. But talking about the businesses itself, I mean, the hotel business contributed about 5% to the company's revenue and operational performance. But if you notice, over 20% of their capital was allocated towards the hotel business. So to that extent, it was a business that, had lower return on capital than all the other verticals of ITC. Most analysts value ITC's hotel business anywhere between 16 to 20 times 2-year forward EV to EBITDA, and that's a near 20-25% discount to the industry leader, that's Indian Hotels. The good part about this demerger is that it's coming at the right time, value unlocking, because the last 2 years have been phenomenal for the hotel industry. The big question is whether this sustains or not. And if it doesn't, then this is perhaps the best time to go ahead and unlock value in this business itself. ITC's FY23 revenue for the hotels business was close to 2,600 crores. The EBITDA was 832 odd crores. So if you look at what the analysts are valuing it at, anywhere between 16 to 20 times multiple, the stock could be valued, the hotel business of ITC could be valued at 12 to 16 rupees per share. And if the sentiments are good enough, maybe all the way up to 25 times, which is at which Indian Hotels trades, you could value the hotel business for ITC at around 20 rupees per share itself. The structure and the fact that there is sell-on news playing out has meant that the stock is under pressure right now.
All right, Mangalam, I recall on Chartbusters you said that this is the big story, and when you say it, we take it very, very seriously, because you have the hint out there that you're going to be bang on. So congratulations, mate. You said it, and the street definitely took note on that one. Well, time to move on then. PFC, that's the one that we were telling you that hit that 52-week high as it signed an MOU worth 2.3 lakh crore rupees. Abhishek joins us to give us a quick analysis on that. Abhishek.
Well, Nigel, as you mentioned, a release has been given by PFC. They have signed a memorandum of understanding worth about rupees 2.37 lakh crore. So this is with 20 companies in the clean energy segment. The segment that they'll be concentrating is solar, wind power, green hydrogen, battery storage, electric vehicle companies and manufacturers of green energy equipment. So the companies with whom they have signed up are Adani, Greenco, Renew, Continuum, Avada, JBM Auto, Mega Engineering and Infra, Rajasthan Renewable Energy, etc. And just to highlight some of the numbers of PFC over the last few quarters, or let's say last 24-25 quarters, they have been improving their asset quality. So in Q4, the gross NPA ratio of 3.91% is the lowest that you are seeing in last 6 years. And the net interest margin, however, has been under pressure for them as well. It's at 8-quarter low of 3.36%. So just to highlight that, fundamentally the net interest margin has been under pressure despite the gross NPA coming down. Back to you.
Okay, Abhishek, thank you very much for that. Deepak is still with us. Deepak, how would you look at this? I mean, the announcement of this MOU with, a couple of lakhs of crores in terms of disbursal, which will happen. It's as they say in financial companies, it's return of what you lend, perhaps, right? I mean, on a consistent basis, which should make all the difference. But the market's very excited. I mean, if they do go ahead and kind of disperse all of this, it's going to become a pretty large book for PFC. Your thoughts?
Yeah, I mean, I think one is to figure out what they mean by, they've signed an MOU. Is it now? Is it over a period of time? I don't know the answer to that, but it does appear like some of them, it's just a memorandum of understanding. It's not an actual loan yet. When those loans come through, it may be on specific projects. We don't know whether it's going to be in, in coordination with, public sector or state government, discoms, or with power producers or with industrial consumers and so on. So it will be the quality of those loans that will determine whether this is good or not. It's an interesting point. I mean, it's very big. It's 2,37,000 crore is not a small number at all. Even for PFC. And I think, if they're actually able to execute it well, this will be a very good deal for the company. They're traditionally at a sub 5 or sub 6 times price to earnings because they have so much exposure to like one sector and so much exposure to state level discoms, government enterprises and so on. We'll have to see now, how these loans change that distribution. If it just increases that dependence, we might see, some potentially bad loans in this area. If they are able to diversify more, I think it will actually help their business get re-rated to a higher level. I don't have too many details. I'm just hearing this from you. I just saw the press release. So I'm sorry I can't add more color to it.
Sure, fair enough. It is a large size if indeed all those loans are disbursed. For now, the market's excited around the potential and the opportunity. Stay on, Deepak. We'll have more questions for you. Do have to take a break before that. When we come back, we'll also have Anand Shah of ICICI Prudential AMC joining in. Welcome back. You just saw those SRF numbers flash through. Oh, TVS Motors as well. It's really rating numbers this afternoon. Profit of 467. That's better than our poll. We'll get you more on TVS Motors as well. Anyway, JLR has turned in a fantastic performance, which has really helped. EBITDA is bang in line for TVS Motors. Beg your pardon. JLR was a separate story. Tata Motors issued a release a couple of hours back as well, and they were talking about JLR. But for TVS, it seems to be absolutely in line for now, at least at the EBITDA level, and the net profit seems to be slightly above the estimates as we can speak. Stock is flat. Just about a 1% decline. The revenue slightly shy, 7,217.
And the margins are impressive. 10.6%. If I read that number correctly, this will be the 7th straight quarter that we're having those margins about 10%. The problem for the stock, it's valuation-wise not very, very cheap. So that could be one reason why we're seeing a bit of a downtick out there. Otherwise, those numbers look perfectly in line. And I think on the top line, there's a bit of a very, very small miss out there. But since the EBITDA number is in line, it's making the margin number look a little bit better, coming in at around 10.6%. Or Deepak, any view on TVS Motors? For the time being, the stock is down closer around 3%. Though these numbers, prima facie, look pretty much in line.
Yeah, well, I haven't seen the numbers in context, so I'm not sure right now how much to comment. But we don't own it in our fundamental portfolios yet. In fact, I've been looking at it for a while. It'll be interesting to see a little bit more into the numbers, especially in some of the units. I think they've been one of the best performers in the two-wheeler space in general.
Deepak, let's do it this way. Let's get in Sonia. She'll tell us more about the numbers and we'll come back to you. Sonia?
Okay, so these numbers are largely in line with what the street is estimating. So let me just put the numbers first. As you started off, the most important bit really is the margins, right? 10.6% compares to a poll of 10.4%, so slightly higher than what the poll was estimating. And if I'm not wrong, this is the 4th or 5th consecutive quarter of an improvement that we've seen in their margins, and 10% plus levels that they've held on to for margins. And that was a big deal for TVS Motor. It was, the margins were hovering in the range of 8 and 9% for many quarters. And in the last 2 to 3 quarters, this 10% level has been held. And hence, that's something that works well for the company. The net profits have come in at 467 crores versus a poll of 450 crores. So that is also slightly higher than street estimates. The revenue front, a slight miss, but nothing really alarming. The moot point is that TVS Motor, the stock has also run up quite a bit. So perhaps a lot of the good news is in the price, but the earnings definitely are improving for the two-wheeler space. Exports continue to be under pressure for a couple of these two-wheeler makers like TVS and Bajaj Auto, but the sense that we've got is the worst of the export performance, export pressure is behind them, which means that on the top line front, domestic demand has come back in a big way, and on the operational front, there are many benefits: lower raw material costs, better operating leverage, a higher product mix as well, and the price hikes that the company have passed on. So Deepak, of course, the stock is under pressure right now, down about 2.5%, but it's had a very strong run. Tomorrow we have Bajaj Auto's numbers as well. The expectation is that things will improve even on the export front quarter on quarter. Your thoughts here?
Yeah, I think the numbers actually, now that I see the release, even on a year-on-year basis, it's some 30% increase in revenues, nearly 45% in profit before tax. So I think the numbers are quite good that way. Quite heartening actually, because it's been 5 years now since the two-wheeler industry has kind of been stagnating. So very positive on that. Maybe Bajaj will also throw some color here and in terms of what they're doing. But I mean, overall, I think the margins which have come up recently have probably been because of the adjustment of raw material costs. And over a period of time, they've not had to cut prices at the sales end of things. So let's see how long. I mean, it's quite good that the margins are coming along quite well. But like you've said, the stock kind of ran up nearly 40 or 50% in the last few months. So maybe this is just sell on news, even though it is good news, what the market is seeing. But I'll wait a little bit more before management commentary comes in. I just want to see if the numbers are actually reflective of on the ground sales improvements, or is it just something particular to this quarter?
Okay, just a couple of more details, right? The other income has gone up substantially year on year. It's come in at about 58 crores this time versus 22 crores year on year. So that has boosted the net profits as well. The net profits for TVS have gone up 46%, boosted by the other income factor. But stripped of that as well, it's a good growth that we've seen of almost 28% on the EBITDA, and the margins have improved 60 basis points on a year-on-year basis. Now, just one final question from my end, Deepak. Since we're talking about the two-wheeler space, there is, of course, this big competition in the premium two-wheeler segment. But the big takeaway this quarter has been that perhaps exports have also picked up compared to what we saw in the preceding quarters. Do you think export-oriented two-wheelers like TVS, Bajaj Auto would continue to enjoy a premium over the domestic guys like Hero MotoCorp? And if you had to pick, what would your, pecking order look like now?
I think you're right. The exports will pick up. Actually, in general, exports have started to pick up overall because the last year has been really weird in terms of the same quarter last year was not great for exports in general, and therefore you're getting some improvement now. I think that improvement should continue at least to the rest of this year, and therefore, the pecking order still seems to be TVS, Bajaj, Hero from all financial performance and portfolio diversification as well. But I would say if there is this monsoon and the impact of the monsoon will only be known towards the end, might tip the scales more towards the lower end, towards the later half of this year. So, after the monsoon, we'll be able to make sure if Hero is actually going to be the laggard of this pack or probably the leader. But otherwise, I'd still say TVS above Bajaj, just from the perspective of diversification and growth. I hope Bajaj proves me wrong tomorrow. That's how I'd see it. I think very interesting space. We don't have much investments here. So I'd like to probably pick after the results come in.
Okay, all right. Sonia, thanks very much for that. That's TVS Motors, more or less in line. Minor miss on the top line. But I guess with the stock having run up so dramatically in the last couple of months, some profit taking is in order today. Let's go to SRF. Now, that's one stock that hasn't run up this year. We approached the numbers with very muted expectations as well. But Sonal is here. She's been waiting by patiently. Sonal, they've missed even those muted expectations, right?
It has, and the management commentary doesn't look so good as well. In fact, first, let me talk about the commentary, because that's where the chairman and managing director says that everyone knows there's a lot of inventory unwinding going on globally, and this will have some impact on the business in the next couple of quarters. It is a chemical major, and if they are saying that this will have an impact in a couple of quarters, it means that the sector is seeing some headwinds that we have been highlighting as well. And it is the chemicals business where the contraction has really impacted the business this time around. And packaging margins, they have substantially come down on a YY and on a quarter-on-quarter basis. For technical textiles, it was a high base, so it was expected to come down anyway. So quickly running you through the numbers as well. Our revenues are lower than the expectations at 3,300 crore rupees, margins at 21%. It is a contraction of 500 basis points versus an expectation of a 200 basis points decline. So that's where the biggest decline has come in as well. Technical textiles margins are down around 800 basis points on a YY basis. Chemicals are down just 300 basis points, but this is the high margin business for the company, and they contribute the most to revenues as well. And this is where the management says they will continue to see some weakness. Packaging margins business, they are down to 6% versus 23% on a YY basis. They also say that stagnant pharmaceuticals and agrochemical industries adversely impacted the demand for some industrial chemicals, and refrigerant gas business, that is also a big business for the company. It was impacted because of domestic factors. The expectation was that refrigerant gas exports were not doing well. So looks like both the markets are not doing so well for the company. We'll of course look out for more management commentary, but it is a top-down miss, and the outlook also doesn't look so positive. So that's why the stock is in focus.
For that, Sonal, thanks very much for that. Deepak, very simple question to you. We know that the cycle is not favoring most chemical companies, SRF included, right? The question is, do you buy these businesses at exactly this time when the cycle is against them? Or do you think that that'll be, pretty much too risky at this point and you would stay away?
To be fair, we own SRF, so I shouldn't tell people that you shouldn't buy or that you should. So we're biased in that perspective. But I think the idea over here would be it's a relatively small position for us, and we're building positions here. But I think chemicals will go through its down cycle pretty much through the rest of this year, perhaps early part of next year. That's fine. It is a cyclical business. There have been overcapacities, overproduction, and in general, demand has not come in the exact areas where a lot of these companies expected, a lot of where I expected as well. But I think if you give this a 4 or 5 year cycle, well-run companies will rebound well, especially if there are no. I mean, if the market cycles price out some of their competitors, the stronger companies will survive and do very well. I believe, in my view, and I'm biased as I said, SRF is probably one of them. I know that the business, actually the results came in much worse than even I thought, but I know that this is going to be a bad quarter and perhaps the rest of the year as well. So I'm willing to give this company more time. I would say look at each company on an individual basis as well, but in general, chemicals and some of the pharma packet themselves will not do well in the next few months, next few quarters, fundamentally speaking.
Okay, Deepak, thanks a lot for joining in and giving us your quick take. By the way, as we speak, SRF has moved to the low point of the day on the back of that cautious commentary. But let's move on then. Madison acquires all the assets of German company Dr. Schneider Group in an all-cash deal for around 118 million euros. To understand more about this acquisition, we are joined by Mr. Kunal Malani, the CFO of the company. Hi, Kunal. Good afternoon. Thanks so much for joining in. Give us a few details. I think the company that you've acquired, they have done a revenue of close to around 470 million euros in the past year. How do you see this number scaling up? And also fill us in with the detail. Will it be EPS accretive from the first year itself?
Yes, let me answer the easy pieces. It will be EPS accretive, number one. And number two, it has an order book of 1.6 billion, which has to get executed over 3 years. So that gives you the run rate somewhere in the 550 odd levels going ahead.
What is the margin on the acquired business, sir?
So the margin currently is negative. Having said so, it's been into insolvency. Obviously, a lot of actions have been taken during insolvency, and we have sought a lot of customer support. Mind you, this is an acquisition which, again, we've been handpicked by the customer, and it is being done at the behest of the customer. So with the support of the customer, that is what gives us the comfort that this should be EPS accretive from day one, and hence profitable from day one once we close this transaction. The customer will also be supporting us in this journey of restructuring, and hence we plan to work with them very, very closely to make sure that this asset not only grows, but now grows profitably and profitable for many, many years ahead.
Okay, Kunal, I suppose this is the cost is 118.3 million euros. It's an all-cash deal. How are you funding this? Is it through internal cash accruals? And also, this company, I think it doesn't have too much leverage. It's just about 20 million euros. But overall, since Madison has been announcing several acquisitions, just in the last couple of weeks, we've heard several deals and acquisitions. What's the plan? I mean, more of this in the months ahead as well? And then are you comfortable with the debt profile, basically, as you go ahead with these string of acquisitions?
Yeah, so look, I think it is 12 acquisitions in the last 1 year. So obviously a fair bit. Having said so, all of them are at fairly good terms, and terms that we are very, very comfortable given our own balance sheet strength and just given how our own business is doing. This one, as well, as you rightly put, has around not more than 20 million. Probably the number would be lower than 20 million as we end, when we come towards closing. But the total spend here would be somewhere in the 70 to 80 million on the equity, maybe another 20 max, as I said, on the debt side. So let's say around 90 to 100 million. And the rest will be all adjustments on, variety of different debt like working capital related pieces. So for 100 odd million, business which was not profitable yesterday, but will be profitable when we acquire it, I think seems like fairly good. It's bought at 0.5 times to book value. This business pre-COVID was delivering, over 40 million of EBITDA. So a fairly, good product portfolio, unfortunately been hit by, COVID and, bad capital structure. It had nearly 200 million of debt when it went into insolvency. So from there, we are buying it now at less than 20 million of debt.
When does this business turn around, Kunal? You're saying that it wasn't profitable, but it will be profitable. So from year one itself, you think that it'll turn EBITDA positive, and also there must be some synergy benefits, right, for your company and the acquired entity. So could you quantify that?
Yeah, so I think it will be profitable from start itself, given the support of the customer associated with it. As I said, it is being done at the behest of the customer, and hence it should be profitable on day one. There's a lot of work to be done on restructuring this asset for giving it a longevity on the orders. So the current orders will get supported. Obviously, as new orders come under Madison portfolio, those have to be profitable at our end. And for that, a lot of operational work has to be undertaken, which will also get supported by the customers. Now, from synergy perspective, look, I think this asset is doing a high-end aesthetic interior part, stuff like air vents, which has kinetic elements to it, design elements, finish elements to it, which augurs well for someone like us who's positioned at the premium end of the market. And as you know, premiumization is playing out across the globe. This asset being, very European-centric, nearly 75% of its business being in Europe. Under Madison, the ability exists to move beyond the current shows to many other customers and many other parts of the world as well. So we should be able to grow this business much faster than the current order book that exists, and leverage the capabilities to be able to service different customer base and the requirements across the globe. There are around about there are many patents to this as well, and it carries with it a 250-member engineering team which supports the innovation around this product. So hence,
okay. So you're saying, Kunal, for the benefit of our viewers, just to recap, what you're saying is that this acquisition would be treated as having turned around right from the time the amalgamation is complete. The deal is done and the acquisition is complete. Is that right?
That is right. Financially, it would be.
And which quarter would that be, roughly? I mean, are we talking Q3, Q4, or when do you hope to complete it?
By Q3 is what we are expecting to close this. So it's subject to antitrust approvals, but yeah, by Q3.
And finally, with the string of acquisitions, like you mentioned, over 12 companies in the last, I think over 10 companies in the last 1 year, where is the current debt equity of the company? And what's the target range with which you would remain comfortable?
Debt equity would be closer to 0.3, so not really of any major worry from our side. On EBITDA side, we should still be less than 2x, and if things go well, we hopefully will be at the same level as what we were in March last year.
Got it. All right, Kunal, good talking to you. Thank you very much for joining in and helping us understand the rationale and, of course, all the details around this acquisition done by Samvardhana Motherson. Okay, with that, it's back to the markets and back to our next guest. The market, by the way, has taken a turn for the worse. We are at the lows of the session, 19,680 now. So it's ITC, it's Kotak Mahindra Bank, a couple of these big boys that are keeping the bulls at bay today in a fairly significant manner. Even Reliance is down about 2% right now. Lever has seen fresh selling, continued selling after its numbers last week. So 1% down on Lever as well. Anand Shah, head of PMS and AIF investments at ICICI Prudential AMC, is with us now. Anand, thank you very much for joining in. So first things first, we are bang in the middle of earnings season, right? And so many large companies reporting. What do you make of the way the market's reading through numbers? I mean, I'll take Kotak Mahindra Bank just as an example, not to get your view on the stock. I know you don't talk too much stock specific. But the market seems to be in the mood for wanting more. It's like ye dil mange more. I mean, Kotak Mahindra Bank comes out with net interest margins of 5.5%, and yet the stock is down. Now people are talking about treasury gains boosting the PAT, etc., etc. I'm just trying to get into the market psyche at this point at 19,500 plus, and the way we're seeing reactions come into these big earnings. What's your thought?
Hi, very good afternoon. I think this time around, and it's not about today or last quarter, but all along last 2 to 3 years, we've been seeing that market's been frankly very demanding. If you see the entire rally, and we've been talking about markets at new high, if I go back into, say, 18th October 2021, when we touched the previous peak, or even before that, market's been only chasing earnings. And at every high, at every new high levels, or after every rally, market is questioning whether this is sustainable. Now, be it banks, generally banks, or now more recently we've been talking about chemical companies. Everywhere, if there is no earnings momentum, if on the contrary, if there's earnings degrowth expected in times to come, market has been not giving a very free run. So I think in a way it is very good. In a way, this is not the market which is ready to buy into any sort of a story, or in any sort of if there is a very strong few quarters of numbers, people are not really extrapolating it into an Excel sheet and saying next few years looks very good, let's go ahead and buy it. So I think it's a very good market. It's debating all the earnings and expecting that if the earnings are good, then obviously they are also rewarding the stocks that you can see as the markets are touching new highs.
Hi Anand, good afternoon. Anand, I want to ask you about the metals pack because I'm just looking at your portfolio and you have the big boy Tata Steel in there and a smaller name Godavari Power and Ispat, which I'm guessing you're holding it for a while, which would have done very well for you. What's your view on metals from here on? The street is a little bit skittish. We saw JSW Steel, they came out with a blockbuster set of numbers, but the stock has got sold into. So that Chinese problem is still weighing on sentiment. Your view?
Indeed, I think more of the same. I think market is saying, look, while the numbers look good today, how is it looking next quarter and the next year, and what sort of visibility is there for all these numbers? And as you rightly said, look, China accounts for a significant demand as well as supply, more importantly demand. And for last 6 months post the COVID recovery in China, we were expecting that the economy will pick up pace, some real estate should pick up pace, and the market is disappointed. The demand is not picking up while the production was higher. So what you eventually saw was significant supply, significant of exports from China, which is not allowing steel prices to actually go up. And obviously what we are seeing is year-on-year lower numbers. My take is, I think, the worst seems to be over for the sector, but what markets and generally investors are asking is how good is the good, and to that extent it's yet to be seen. We will have to keep on an eye on China and how we will have a Politburo meeting in coming week and see what they can do to first help their own real estate and see if there is an uptick in that metals demand in China. That would be quite a key question for which the answer is required.
That's Tata Steel. Anand, I noticed in your contra portfolio, you have HAL, which of course would make all your investors extremely happy, I'm sure. I think you own just under 4% of it, if I'm not mistaken. But let me ask you, what have you made of the manner in which defense stocks have shot through the roof? And hand on heart, right now, when you look at valuations versus the opportunity, I mean, does that equation still make sense? Would you be comfortable, say, adding on to your positions in the defense space, given the current pricing?
I think we've seen in quite a few of our companies, we have seen this phenomena when actually the value stocks, and as I call value stocks, the state-owned companies, be it in defense, be it in banks, everywhere, have been fairly underpriced historically. Now, when actually you see growth coming through in many of these value stocks, you not only get one round of boost because of the growth in the earnings, but then obviously there's enough and more room for the PE beating. So I think even after a sharp rally, many of these companies, while obviously they are far more expensive than what they were before, but if you have some visibility of earnings, you have some visibility of the growth, they're not like significantly outpriced. Coming back to many of these new industries, and particularly we've been consistently talking about manufacturing-led recovery for the Indian economy as well. Manufacturing is one missing link. While we did very well in IT services, we do very well in financial services. Economy has been able to create jobs in services But manufacturing was something we had not been very successful. More recently, we are seeing markets having quite a lot of interest in manufacturing in general, defense in particular. But obviously, the ancillary industries like Capco's, industrial products, and more recently, power, I think we are seeing quite a lot of excitement. So I think early days, as market has been keeping an eye, we are also keeping very close eyes to what are the market prices, the stock prices are reflecting, and whether they can able to deliver the same. So I think it's a cautious view here on the entire market. There has been a sharp run in many of these companies and sectors, and one needs to be very careful, very careful, given that the rally is quite sharp and earnings generally takes a little longer, and at times they don't deliver on the earnings also.
Okay, Anand, good hearing your thoughts on that cautious note. We'll thank you for joining in and talking about a couple of sectors, and we look forward to having a chat with you rather soon. By the way, before we go into that break, just want to take a quick check on the markets before Surbhi tells us more about the Twitter logo. You have Tech Mahindra that's moved to the low point of the day, so I want you to pull up the intraday chart out there. HCL Tech, actually the tech pack itself has sold out. You pull up the IT index, that's moved to the low point of the day. Kotak Mahindra Bank as well as down, and the two big boys, you have Reliance Industries and ITC. They are struggling a little bit. So the bulls really don't have any hiding point as of now, and that's why we're virtually at the low point of the day. But Surbhi, tell us more. Twitter updates its logo. The original bird is gone.
Has flown away.
Bird
has gone. It's been years and years. I think it's going to live on, and I think a lot of the branding classrooms around the country, around the world as well, the way the brand was created, the way it got conversations flowing, a new style of public debate. That's what Twitter was known for. But anyway, the blue bird is now history. Check your account, Nigel. You'll see the X. It's all about the X now.
Well, as I do that, we'll slip into a short break. Come back, we'll get you some more buy and sell trades. Our technical experts will be back with us.
Welcome back. Well, let's get Mitesh back in. We've seen a pretty sharp decline in the last couple of minutes as well, so good idea to look at the technicals again. Mitesh, what do you make of the weakness that we're seeing? What's the final advice now? Mitesh? Okay, I don't think we have that link through to him. But as we've been pointing out, Nigel, I mean, there has been a fair amount of volatility and choppiness. I mean, that's a full 70, 75 point decline now.
I'll be waiting to see the institutional numbers, whether that sell number was a flash in the pan or have the FIs, turned around a little bit. They've been pumping in the big money. Has that turned around? Well, we'll have to wait by next couple of hours. We'll know that. But I think Mitesh is back with us. Mitesh, give us a couple of picks.
Yeah, so I think, on the BTSC side, I have one M&M Finance, which has moved up nicely. That's a BTSC which is top at about 317, 316 half. And I look for a target of around 330 over here. And on the STBT side, I choose the United Spirits. I think there's a big fall which has happened in the morning and then slowly cinching down. So take an STBT with a stop at 990 for targets of 955.
All right. Thanks a lot for that, Mitesh. Well, in the next 3 hours or so, Tata Steel will be coming out with its set of numbers at around 6 p.m. or a little bit after that. Let's run you through the expectations. Top line degrowth of close to around 9%. On a year-on-year basis, there'll be a degrowth of more than 60%. That means margins will compress. So on a year-on-year basis, those numbers will look very, very weak. Now, the operational numbers are already with us. So we have seen that in the India business, the deliveries or the dispatches are up by close to 18%. In the European business, they had a shutdown, which they warned us about in the Netherlands facility. So you'll have those volumes we already got, which are down by close to around 8% odd. And Thailand, small part of the business, but that as well was down in double digits. What are the key factors at play? Realizations will get some support because the auto contracts, well, their prices have been revised upwards. So on a sequential basis, prices actually could remain flattish in comparison to what we have seen in the market, where steel prices actually are lower quarter on quarter. Coking coal cost, yes, they have corrected, but on a quarter-to-quarter basis, actually, they'll go up by $15 to $20 because they'll be sitting on some high-cost inventory. And the profit number is seeing a sharp contraction. That's because of the British Steel pension. That's a non-cash expenditure that will be marked out there. So that's what will result in the profitability getting compressed further. The two key numbers to track on the India business, you're looking at the EBITDA per ton of around 13,500 rupees odd. A bit of whispers that maybe that number will get beaten, because we saw what happened with JSW Steel. So we'll have to keep an eye out on the India business. On the European business, the pain will continue. $90 per ton in terms of a loss, that's an EBITDA loss. The key monitorable will be debt reduction, capex plan from year on. Do they have any inorganic plans? And also what's going on in terms of the European operations. So we'll know about most of those details in the next 3 hours or so. For the time being, we'll slip into a short break, come back. Anand Tandon will join in to give us a couple of views on some stocks. Stay with us.
Okay, as we're setting for a wind down of the day, ITC has displaced Kotak Mahindra Bank to be the worst performing stock on the Nifty, 4% down. Anand, just brief thoughts. I know it's very early and not getting you into the specifics just yet, but the market had been awaiting this demerger for a very long time, looking at, the potential in the hotels business. What do you think is the issue? Is it the way it's been structured? What would your advice be around it till we have more clarity?
Well, there isn't too much problem right now in terms of the way it is structured. All you're saying is that ITC is not completely exiting the business and will continue to play the role of a promoter, because otherwise ITC itself claims to have no promoter. So from that point of view, the hotel business will also have some advantage that, it's finally a cyclical business. So they will be able to get money from ITC if, as a promoter, if required at a later date. However, I think it is actually done at the right time in terms of the cycle where we are, because at this time, hotels are firing on all cylinders, and I would imagine the EBITDA this year will be fairly strong from the hotel business. So that's a good time to demerge. Obviously, the stock has run up quite significantly. So a little bit of give is possible. At the end of the day, you cannot be more valuable than HLL all of a sudden without facing some resistance in terms of the stock price.
And being the market capitalization is higher, Anand, right now. But in fact, just three years ago, the market capitalization of ITC was half that of HUL. So we have seen, some of those positives getting priced in. Anand, today what's struggling is some of these top banks. Kotak Mahindra Bank as well is down under pressure, down close to around 3% odd. Is this a buying opportunity? If yes, what would you buy?
So, it is a buying opportunity only if you have the patience. So frankly, I think what has happened now is that the market to me is finding it more and more difficult to find stocks that you could justify on the basis of near-term growth. So now you have to look at sustained long-term growth and see whether or not you are still looking at buying it. Clearly, the banks are reporting probably one of the best numbers ever. And this may continue for maybe a quarter more, though my suspicion is that you will find that margins will start getting squeezed from the next quarter onwards. And this is probably the best that you're going to see. Now, that doesn't mean that the numbers will not improve from here. Clearly, we are in an upcycle in terms of banking, which is likely to last for at least another 2 years in terms of the profitability, and after which NPAs, etc., is something you have to worry about. But for the near term, I don't see any major issue coming through. The NPAs will take a while. Balance sheets are good and clean, and most of the banks which have good liability franchises like Kotak and HDFC are going to likely do reasonably well. So weakness certainly should be looked at, but you have to look at it in the context of where the overall market is. Market is beginning to look a little toppish now, and also within that segment, the banking and financials is probably the most overowned sector for good reason, but still, there is a limit to how much institutions will be able to increase their holding there.
Okay, all right, Anand, thanks so much. A short chat today, but thanks for giving us your view on a couple of those stocks. Wishing you a good evening ahead. Well, we're almost done then. Just a few seconds left before we close down the markets. The Nifty is going to go home with the final tick actually at the low point of the day. ITC, the long-awaited news did come about with regard to separating of that hotels business, but maybe not in the form that the street wanted. So that's why that stock's down. It's the biggest loser, down 4.5%. Kotak Mahindra Bank as well. Numbers look pretty okay, but that one goes with the cut of around 4%. And Tech Mahindra down close to 3%. On the winning side, Dr. Reddy's as well as IndusInd Bank, both of them did quite well, Surabhi.
Well, absolutely. That's a large cap screen. The mid caps also, the color did change. I mean, battling throughout the day. Finally, the index gave up, ended with a cut of just about 0.2%. If I talk about major movers and shakers, in terms of the result reactions that didn't flow too well today, we had Tejas Networks down 8.5%. IGL was down about 5%. SRF's numbers didn't inspire much confidence, 3.5% lower there. Vedanta was down about 2.5%. Biocon, with the inspection at their Malaysian plant, the market quite concerned about it, 5.5% lower on that stock. AU Small Finance Bank, again a negative result reaction, 4% down there. So that's where the bulk of the weakness was. But again, there are some sort of silver linings here and there. So some of the PSU names like SJVN, PFC, REC, these were stocks that were up and about. Texmaco Rail's numbers were very, very smart, so 12% up over there. So a smaller stock like Thangamal Jewelry rose on the back of some very strong Q1 quarterly results. So sort of mixed trends, but overall, yes, the mood was a little somber, and a late sell-off did wipe off 80 points from the Nifty. Well, with that, we're out of time on this edition of Closing Bell, so it's a wrap from the entire team. Thanks for being with us, but don't go anywhere. Our special offering, Market Masters, coming up next.